Okay, this is a daily market review for the Nasdaq on the 6th of October 2025. So this morning I gave to the roundtable that we should be expecting to trade into this low resistance liquidity, that is all-time highs, and it did. So very nice. Drops below Asia, below midnight opening price. That is the classic buy day model. Monday, Tuesday, or Wednesday. If you get a run against your underlying bias and it's below midnight opening price, then that meets the criteria to look for buys. Takes Asia. This is a London style soup setup. If you look at your 5-minute chart, if you look at your 15-minute chart, and even if you look at the lower ones like the 1-minute chart, you'll see this. And maybe there's something you can look into in your own time. But then we isolate this period of price action with the bounce price range, trades higher, and between 5 o'clock and 7 o'clock gets this expansion, retraces 7:30, runs up into all-time highs. Now this, if you zoom out, is a very clear market maker model. These boxes, ignore them, they're just kill zones. But here we have our consolidation, distributes lower, redistributes lower, smart money reversal, trades higher, low risk buy, accumulates, reaccumulates into our original consolidation high, which is also all-time highs. Now, I always like to highlight market maker models in the daily reviews inside of the roundtable. This isn't going to be as detailed as the one that the roundtable gets, but I always use the market maker models in my narrative reading, and it's the sole reason that I'm able to get my daily bias right so often. It's because constantly the market's going to be moving in a market maker model, and either I'm using swing grading or I'm using market maker models. And you want to know how I get my high time frame bias? That's how. I'm looking for low risk buys or low risk sell setups. So this here is a low risk sell, this here is a low risk buy, and those are two parts of a market maker buy model or a sell model. But then today we had a very choppy New York AM session. As you can see here, when we open up, we leave this spool point from 9:30. We just instantly drop lower, 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 create our first presented fair value gap. It is respected with bodies, still respected, still respected. Eventually we run through it. We're going to ignore all of this chop, but yeah, the roundtable's going to know why this happened. Going into the PM session, we put in these relatively equal highs prior to the PM session, so we have also relatively equal lows. So from 12:12 all the way to 1:15, we have these relatively equal lows. We end up sweeping the major buy side liquidity, aka all-time highs. As you can see, it trades above, and it trades above, and it leaves, when it trades below, and it leaves these inefficiencies there. That makes this a bounce price range. Now, it doesn't give us the optimal condition for a bounce price range to deliver. The optimal condition is if we create the bounce price range and instantly, like from here, trade away from it without trading back above the midpoint. It can trade into the high of the bounce price range and it's still technically valid, but you're going to see much slower price delivery. Like we saw here, it was very slow, very back and forth, and you'd get these periods of consolidation, then it runs a bit, retrace, consolidate, deeper retracement than you would want to see, and then it finally gives up the ghost and runs lower into relatively equal lows formed inside of the first presented fair value gap. So if you drag out first presented fair value gaps from the entire day, you're going to see a lot of reference points where it's used constantly. So here, 9:37, 10:05, 10:21, and then you can do the rest throughout the day. When you're consolidating inside a fair value gap, or inside of the first presented fair value gap more importantly, or you're giving very good reactions to it like this, it's a sign that it's going to give you some level of algorithmic price delivery. Now we got a lot of choppiness going into the AM session, for most of the AM session. Post 10 o'clock we had that sell side delivery, it does trade higher, that is a silver bullet setup, but it's not clean. You see this? Why could this possibly be happening? Well, we keep mentioning this, but fundamentally the market is in a very bad place right now. Technical analysis aside, we have very high resistance conditions fundamentally with the US government shutdown, no news releases, all-time high conditions, a lot of things are going on. But then if you take a look at the dollar index and you see it running up whilst the Nasdaq is also running up, that creates high resistance conditions because if the dollar's going up, the Nasdaq should be inclined to go lower. But if they're both being run in the same direction, it's a sign that there's some level of manual intervention, or that there's just going to be very high resistance conditions. And as you can see, in a market where the dollar's going up and Nasdaq wants to go up, but it's being held down by a bullish dollar, it's going to chop around, which does happen. And even when we do get price delivery, it's very slow. This is technically a market maker model. Consolidates, reverses, trades back into consolidation. But is this a tradable one? It would be very hard to trade this. You could have traded that as a silver bullet, and technically, yes, it would have worked. But you don't really want to be selling all-time high conditions. You want to be letting it trade lower and then trade or buying it back up. So this silver bullet buy in the New York AM session, where we took out that 944 wick low, and then we trade back higher, that's the setup that you should have taken. The sell setup, although it played out, it isn't the correct move to be making in an all-time high market environment. Yes, we swept the buy side, but even with a clean setup, like, we trade above it, we trade below it, we get this bounce price range, market structure shift, good fair value gaps, bearish order blocks. It does deliver, but it's very back and forth, which you don't want. It can still go to your take profit, but this is a worrying position to be in. If you're in this in real time, do you want it to be like that, or do you want to wait for it to be on side where it's going to deliver very quickly and low resistance? It's just going to run to your take profit, smooth, quick, fast. Those are the trades that you want. And in order to get those, you have to filter out trading when you're in a high resistance condition. And today, we did have a high resistance condition. Okay, now we're looking at the dollar index. We've been calling this to go higher in the round table for like a week and a half now, and although it retraced quite deep, which we were allowing for because we still had the breaker block, we still had the fair value gap, this was all perfectly allowed for, plus this bullish order block, it was just not ideal. We wanted to see it trade right off this and then pop higher into the drawn liquidities, this high, and this high, and then potentially even this bounce price range. But very slow, very deep retracement, which we didn't want. But now it has begun to respect our technical analysis. However, I'm not really caring if it does by this point because of US government shutdown. Very simply, it's not going to enable good trading conditions. The dollar is not going to be something you can really give good technical analysis to. Yes, you can look at it and you can make slight predictions like, here's the liquidity, here's the PD arrays, this is the narrative. But the fact is, anything can happen at any day, and we don't know what effect the US government opening back up will have. We don't know if news data releases are just all going to come out at once. This isn't a market environment where you can really accurately predict anything. So, although my technical analysis does say we should trade into the original consolidation of the lower time frame market maker models high, being this drawn liquidity, this one and this one, with this one being our low hanging fruit, I'm not, giving the prediction that, yeah, it's going to trade up. I'm just saying this is where I'm leaning towards. But if it doesn't happen, don't hold it against me. Because there's nothing here that fundamentally, with what's going on in the US and the world, it's just very, very difficult to say anything concretely. But we did have a very bullish Monday, and we'll see if we can begin to trade up for the rest of the week. It is a bit demotivating having this very long wick, but we'll be looking at this daily wick levels going into tomorrow. So back to the Nasdaq, we had that silver bullet buy setup, the silver bullet sell setup, and the classic buy day entry or the London reversal, which you could have taken off at the all-time highs, or if you had held it, would have got very, very long running trades. With a classic buy day setup or sell day setup, the reason it's such a high yielder is because you don't take your entire position off all the time at a specific point in price. You can hold it with the expectation that it's still going to trade higher. So you position yourself very favorably. With a classic buy day setup, you would have positioned yourself around here. Literally the low of the day. And then you would have held it until the New York session, would have got it there, or at all-time highs, we've probably taken that off all-time highs. You get from here to here. That's a very, very large lion's share of the daily range. You don't need to pick out the lowest low to the highest high. It's not really that beneficial to do that when you can just capture more reliably the majority of the daily range, like this. In my opinion, the classic buy day is such a high yield just for this reason alone, because there's no real fixed take profit. You can let it run, and you can let it run, and you can let it run, and it keeps trading in your favor because you're aligning yourself with a high time frame bias. And for the free members, to align yourself with a high time frame bias, you really need to be looking at the London session. Because if you're very bullish on the day and you can get inside the London session, or the London open kill zone rather, then you have a very, very optimum chance of getting in on the majority of the daily range without really risking a whole lot, because in a bullish day, a classic bullish trending day, London is going to be the low of the day most of the time. Sometimes it'll come and sweep that inside of the New York session, like here, the New York Open, sweeps it and then trades back higher. And we see that all the time with silver bullet setups. But generally, this will be the low of the day. But that is it for today's market review. It hasn't been too technical, but I want to keep it a little bit more basic right now so that we can just focus on nailing what setups formed, which ones could have been easily taken, and with the current state of the US government. I don't really want to be too deep into technical analysis because I'm not trading this market myself right now. I'm staying out for the most part, just because I'm not willing to risk anything inside of an environment that I'm not familiar with. Because I've never been through a US government shutdown before. I'm not that old. I'm not that old at all. So, thank you for watching. Hopefully you've come away with something, and I'll see you tomorrow in Discord.